Okay, now I will give you an update on my eye. So I went to the doctor after class on Tuesday and I said, "What's up?" And she said that I was washing my face too vigorously because I have delicate blood vessels and I just burst one. And so I said, "Well, what's going to happen from here?" She says, "Well, that blood is going to make its way and it's eventually going to look like someone punched you in the eye. So probably on Tuesday, I will have a black eye. And I'm telling you that now so that you guys won't think that my wife spousally abused me over the weekend."
Can't you just lance it?
You know, when I first saw it, I thought, should I? But I didn't. I probably...
You don't have to walk around looking like you got a black eye.
Yeah, well, at this point, though, there's not like a big puddle that I could poke into and lance it. See, that's Generation X for you. We like see something and we're like, we're going to cut that shit out, right? Okay, questions before we get started? Okay, now we are on to options and corporate finance. Let's start with talking about the general idea of an option. If you have an option, it gives you the right, but not the obligation to do something. It means you can do that thing, but you don't have to. For example, if someone asks you to marry them, they are giving you an option. You can marry them, but you don't have to. When someone gives you a job offer, it is an option. You can accept the job, but you don't have to. So that's the concept of the right, but not the obligation. Okay, now in finance, when we talk about options, it's the right, but not the obligation to sell or purchase a certain asset at a given price on or before a certain date. And we'll get to that on or before thing. There's a couple of squishy things there. If you decide to if you decide to do the thing that you have the right to do, we call that exercising the option. Exercising the option. So when you go ahead and say yes to the marriage proposal and you get married, you have exercised the option that the other person has given to you. When you accept a job, you have exercised the option that the company or employer has given to you. When we talk about finance, we're talking about the act of buying or selling the asset. So the option gives you the right to buy or sell the asset, and if you exercise it, then you've gone ahead and done that thing that you had the right to. Now, the price at which we have agreed upon in advance that we're going to do this buying or selling is called the strike price or the exercise price. It's called the strike price or the exercise price. Let's see, and then we've got expiry. Now I had expiry written up here, and the student says, "Isn't that misspelled?" Expiry is the British term for expiration. If you go to the UK and you pick up a package of cookies, on the bottom will be an expiry date. Do you guys in Canada use expiry? Oh, it's also in French. Wow, learned something new today, right? Okay. By the way, did you guys know that the English were invaded by the French in like 1100, and so what we think of being English today as far as the people, actually there's a lot of Frenchmen in there, but it's not really real Frenchmen because they were Vikings. It came from, oh yeah, it's a big old mess. So if you're very proudly English, you're probably just a mix of Viking and French, everything else. Wow, way off into the grass there. Okay, so expiration date. That's the date upon which you can, so if it's we'll get to these different styles of options, but either on or before that date, you can exercise that option. But after that, the option disappears. After that, the option disappears. And so if you do not exercise the option, then that option is going to expire and it will be worthless. Questions so far? Okay. Now let's talk about the difference between European and American options. European options The only day upon which you can exercise the option is the expiry date. For Europeans, it's the only day that you can exercise it. But American options, you can exercise it at any time before or on the expiry date. Now, mathematically, unless there's some dividend weirdness involved, we can prove that it is never optimal to exercise an option early. It's never optimal to exercise an option early. And I'm going to show you why that is. We're going to talk about the intrinsic value and the speculative value. And if it's before the expiry, there is still going to be some speculative value to that option, and you'd be better off to sell the option than to exercise it. Now, let's talk about how we're going to apply this idea of never optimal to exercise an option early to your life. Let's say someone gives you a job offer, and they give you 2 weeks to respond. Do you immediately accept the job offer? It's never optimal to exercise an option early. So the answer is you wait until the latest possible time. What could happen in the meantime that would make that a good decision?
Another job offer.
Yeah, you could get another job offer. By the way, with Generation X, we were told if you accept a job offer that to renege on that decision, R-E-N-E-G, would be a bad deal and that you're going to get blackballed. Now what do people do? They just basically don't show up on the first day if they decide they don't want the job. That's not cool. Don't do that. But the idea is this. If I don't accept the job offer until the last possible minute, then I have the option to accept perhaps another job offer. Okay, now let's talk about in the money. If exercising the option will produce a positive payoff, then we say the option's in the money. Now we're going to talk about the difference between payoff and profit. Payoff is the amount of money you receive for exercising the option. The profit, we're going to have to take into account how much you actually paid for the option. If it's in the money, it's going to result in a positive payoff. If it's at the money, then exercising the option would result in a zero payoff. And we would say that's at the time where the spot price, or stock price if we're talking about stocks, was exactly equal to the strike price. And then out of the money, if you exercise it, it would result in a negative payoff. Should you ever exercise an out of the money option? Absolutely not. It's crazy though, I've seen people do it because they wanted to get the value out of their option for whatever reason, and then they go ahead, oh, it's lunacy. Okay, questions so far? Let's talk about call options. A call option gives you the right but not the obligation to buy a given quantity of some asset on or before some time in the future at prices agreed upon today. I want to throw this in here right now. This is important stuff. You need to write it down. Every options contract in the United States is for 100 shares of stock. Every options contract in the United States is for 100 shares of stock. And so if I wanted to get myself the option to buy 1,000 shares, I would need to buy 10 options contracts. Now this is important because a lot of people will go out there and they'll buy, so they want to buy 100 shares, they buy 100 contracts. That's insanity because now they've got, what, 10,000 shares that they're on the hook? Yeah, don't want to do that. Okay, so when you exercise the call option, you are said to be calling in the asset. You're said to be calling in the asset. And of course, in order to exercise that option, you're going to have to pay the money to go ahead and buy that asset. The price that you pay is the exercise price. Let's talk about what is the pricing of these options. So at expiration, an American call option is worth exactly the same as a European option. So that's what we're going to talk about here, because at that point they've got the same characteristics. If the call is in the money, that means the stock price is higher than the exercise price. So S sub t minus E, S sub t is the stock price right now. E is the exercise price. By the way, you may also see the exercise price or strike price denoted with the letter K. Why would a strike price be denoted by the letter K, Mr. Ingram?
American baseball.
American baseball, right? Yeah, I'm not a big baseball fan, and they taught me that in finance doctoral school. I'm like, oh, phew, interesting. Okay, but for this class, we'll use E. Now, so if stock price is higher than the exercise price, then that is the intrinsic value of that option. If it's out of the money, basically, it's worthless. It's worthless. There's no value in it. And so we say on the day of expiration that the value of a call option, which is C, is equal to the maximum of either the stock price minus the exercise price or 0. So if this thing is in the money, S sub t minus E is greater than 0. So the value of this thing would be S sub t minus E. If this thing is at the money, the value of S sub t minus E would be 0. And so your choice would be the greater of 0 or 0, which is? Oh, come on. You don't even have to know math to do this one, right? It's 0, right? And then if this thing's out of the money where the stock price is below the exercise price, then that thing is negative. So which would be greater, a negative number or 0? 0. And so this little formula tells you the value in all situations. Any questions?
So if it's the max, if C in a call option is greater than 0 on your investment, then is that a loss?
Okay, so remember we're talking about a payoff here. You've already bought this thing. But what's the value will be the payoff. And so if the stock price is $10 higher than the strike price, it's going to pay off $10 per share. That does not tell me, however, about what I spent for this thing.
Right. So there's more calculations you have to do to determine that it's a loss.
Oh, we'll get there. We'll get there. Not only will we do calculations, we'll draw pictures.
I'm good with pictures.
Yeah. Okay, so speaking of pictures, here we go. We're talking about call option payoffs here. On the horizontal axis, we have the strike price. On the vertical axis, we have the payoff. And we said that that payoff is going to be 0 right up to, at all stock prices up to and including the exercise price. But after that, the payoff will increase by $1 for every dollar of increase in the share price. And so after that, there's a 1-to-1 correspondence between your payoff and between the change in the payoff and the change in the stock price. Now, note that this is the payoff from buying a call option. We'll get to what it looks like from selling a call option. By the way, it's going to be exactly the opposite. And here's why. In all of these derivatives, a $1 gain for one party is a $1 loss for the other. In fact, we refer to all of these options and things as a zero-sum game. What does that mean? It means if one person makes $1, another one loses $1. Is that true in stock investing? No, because we're creating wealth, right? So options necessarily makes winners and losers, whereas stock we can all invest and win. Does that make sense? Okay, now let's look at what happens when we start to consider how much we paid for this thing. Let's assume that we paid $10 for this thing. That means we're going to have a $10 loss right up until we hit the strike price. And then, by the way, the profit is just the payout minus the option premium that you paid. And we paid $10 here. That's going to mean that we're at a $10 loss right up until we hit 50. And then we are going to gain $1 in profit for every dollar that the share price goes up. When do we break even?
At 60.
At 60, which is the strike price plus the premium. We break even at the strike price plus the premium. Now, let's ask this question. If the stock is at 55, do you exercise the option or not? Instinctually, people say no. But if you don't exercise the option, how much is your loss?
$10.
$10. If you do exercise the option, how much is your loss? $5. And so you lose $5 less if you go ahead and exercise the option. And so we always exercise all in the money options at expiry. We always exercise all in the money options at expiry. We may still have a negative profit, but it will be not as big a loss as it would have been if we hadn't exercised it. It's a common situation for students to think that we shouldn't exercise until 60 because it's only profitable after 60. Any questions? Okay. Now let's talk about put options. A put option gives you the right, but not the obligation, to sell shares to someone else, the option seller or writer, for a agreed upon price at some point in the future. And so basically this becomes like an insurance policy. If I had a put option with a strike price of $30, if the share price drops below $30, I can exercise that put option, and it's basically an insurance policy that lets me know I'm not going to drop below $30 for each share that I sell. Put options, oh, by the way, call options are useful when you think the stock price is going to go up or down. Up, right? You would buy a call option if you thought there was a chance for the price to go up. A put option is used to protect your value, or if you think the shares are going to go down. If you think the shares are going to go down, then you would be buying a put option. Okay, when you exercise a put, you are putting the asset to someone else. They're not necessarily liking it, but that's what's going on. You are putting that asset to them. They are forced to buy it. So let's take a look at the value of a put option. At expiry, once again, the American put option is worth exactly what the European put option is. There is no time value or speculative value left in the option. If it's in the money, it's worth E, which is the exercise price, minus the strike price. This time, notice that they're swapped. The put value has value. The put option has a positive payoff when the stock price is below the strike price, because I'm going to force you to buy shares for $30 that are only worth $26. So that's when the put option has value. Otherwise, when it's not in the money, it's worth 0. And so we can put our formula up here. The value of a put option is either going to be the maximum of the exercise price minus the stock price, or 0. If the exercise price is greater than the stock price, then that first piece is positive, and so that's greater than 0, so that would be the value. What happens if the exercise price is equal to the stock price? What's the value of the put option then? 0. And what happens if the exercise price is less than the stock price? Then the put options also were zero because E minus S sub T would be negative. And the maximum of negative or zero would be zero. So let's look at put option payoffs. And the way to think about puts is to start over here on the right and work your way back. As that stock price falls, as long as you're above the exercise price, this thing, the payoff is zero. But as soon as you hit 50, then for every dollar the stock price falls, the value of that put option goes up by $1 because the payoff goes up by $1. And we can keep letting that stock price fall all the way to zero. That's where we have the maximum payoff to the put option. By the way, notice this, there is a maximum payoff to put options. It's the strike price. Can you say the same for call options? No, in theory, the payoff to a call option could be infinite. We know stock prices don't go negative, so we're limited on the downside, but the upside is potentially infinite. Questions? Okay, now what happens when we consider when we look at the profit? We have to consider the amount that we spent for this thing, which is called the premium. The premium here is $10. And that means that you've got a $10 loss as this stock price falls right up until you hit 50. And at that point, your profit is going to increase by $1 for every dollar the share price drops. And so, where would our break even be? In this case, it would be the strike price minus the premium. It would be the strike price minus the premium. And what's going to be our maximum profit? Actually, you see this over here on the left-hand side where it says option payoffs? I want you to scratch over the word payoffs and write profit. Scratch over the word payoffs and write profit. I've been using this slide for years now. First time I've noticed that. So scratch over payoff and write profit. The maximum profit that you can get out of this would be 40 because the maximum payoff is going to be 50 and you paid $10 for the thing. So the maximum profit will be 40. In theory, what's the maximum profit from buying a call option? What's infinity minus 10? It's still infinity, right? Questions? Now, by the way, what we were talking about here are the payoffs and profits from buying the option. There's a person on the other end called the seller or writer of the option. And their payoffs and profits are exactly the opposite. They're exactly the opposite. And so if you think about put options, if you sell someone a put option, there is a floor to your losses, right? Because the maximum profit they're ever going to get out of you is the strike price minus the premium, right? That's the most they're going to get off of you. But think about a call option. If you sell a call option, then your losses are potentially infinite. Let me say that again. If you sell a call option, your losses are potentially infinite. Now, let's talk about two terms here. Because this is, by the way, is it really dangerous to have potentially infinite losses? Oh, yeah. And so, how do you keep from something like this ruining your life? And it turns out there are two ways to sell call options. Covered and naked. By the way, this is about as exciting as finance gets right here. A covered call is when you own the underlying stock. A covered call is when you own the underlying stock. And this is safer because no matter how high the stock price is at the point that you sell that you are forced to sell your stock, you have the stock already purchased that you can hand over, right? And so with covered calls, you have a potential limit to your losses there, your true cash losses. But what if you decide, hey, wait a minute, I figured out I can sell options without actually owning the underlying shares. Wouldn't that be cool? I'm going to get the premium, and then hopefully I won't get called out, and then I'll just get to keep the money, and I never have to buy the stock. The danger there is, what if the stock price just goes whoo, way up? And now you're on the hook to go out there and buy this stock at the expensive price and sell it to the holder of the option for the strike price. That can be truly devastating. So I used to actually do covered calls. I bought a firm, I doubt they're around anymore, but this was their ticker symbol, Gene. Gene. And they were, guessing from the name, they were a biotech firm. And I paid $7 per share. And here's what I would do. And by the way, how many shares did I have to buy? Yeah, I got to buy at least 100, right? And so I went out and bought 100 shares at $7 a piece. So I had $700 invested. Then I started selling covered calls. Why would people be interested in buying the call options of a biotech firm? Yeah, so what do biotech firms typically look like? Their business model is this: lose money, lose money, lose money, lose money. Find the cure for herpes. Woohoo! Right? Lose money, lose money, lose money, lose money. And so basically this call option, you're like buying a lottery ticket that you're going to be, that during the period of this call option, then you are going to be able to participate in one of these huge upsweeps, right? And so I kept selling the covered calls, and then eventually I got bored of it. By the way, the United States government views all of the money that you make selling call options as short-term gains, and so they're taxed as regular income, and it's the highest tax rate that you can pay, right? It's your marginal income tax rate. Okay, so I got tired of messing with it. I got tired of dealing with it on my taxes, and I said, you know what? Forget it. I'm just going to sell this stock and get out from under it. And so what I did, because I'm not a greedy man, I put in a market sell, which means I'm going to sell at a certain price, or not market, what's the name when you put your, I know this is sad for a finance professor to have to ask, but keep in mind I'm getting old. So there are market orders, and then there are orders where you put in the price. So I put in an order to sell at 21. Because I'm not a greedy man, 200% profit is plenty enough for me, right? And so I put in the order to sell, and I wait. And that order actually dies, because they eventually will cancel your order. So I put the order in again. And this time I'm sitting at my desk and I get an email that says, congratulations, your stock has sold. And it says it sold for $22 a share. And at first I'm like, woohoo! I got my 200% profit, plus I got an extra $1. Isn't that cool? And then I thought, wait a minute. When that is supposed to, as soon as it hits 21, it's supposed to sell. What could cause me to, instead of getting 21, get 22? Any ideas?
They found a cure or something.
Yeah, and the stock price is going up so fast between the time that my order, they pushed the button on it and it actually filled, it had gone up by another $1. And I start to feel sick in my stomach. And I go out and look at the price of the stock. It was $106.
Dang.
Yeah. Oh yeah. Oh my goodness. I thought I was being greedy wanting a 200% profit. Now, assume that at that point I had had a call option that I had sold on that stock. Now I've got to turn this stock over that I paid $7 for. Let's say that the strike price was 21. I'm actually losing, what, $85 a share on that, because I could have held on to the stock and sold it for 106. Does that make sense? Would I have been thrilled at that point to have already had that 100 shares? Absolutely, because I had $700 invested in those shares instead of going out and buying them for $106 a share, which would have been $10,600. Does that make sense? And so that's why we call going naked is so dangerous. Do not do this. Do never do that. It's insane. Because you have potentially infinite losses. Questions? Okay, so let's talk about option value. So far, everything we've been talking about has been on expiry day. There is no time left. There's no time left for the price to go up or down. And so at that point, it's all intrinsic value. But if you go back in time, away from the expiration date, the expiry date, you'll see that the options actually sell for more than their intrinsic value. The options sell for more than their intrinsic value because there is still time. There's still a chance that the option, the stock price is going to either go up and your call option will increase in value, or the stock price will go down and your put option will increase in value. And the longer the time until expiry, the greater that speculative value is going to be. So, when you see an option premium out there, know that there are two components to that. There's the intrinsic value and the speculative value. And we're going to demonstrate those. We'll look at some option quotes here in a little bit, and we'll be able to figure out just by looking at the option quotes, what is the intrinsic value and what's the speculative value. Now let's talk about selling or writing options. So far we've been talking about buying or holding options. On the other end of that transaction is the seller or writer of the option. And it's the buyer that has the right but not the obligation. The seller has an obligation to do whatever the buyer decides. They have the option to do, or they have the obligation to do whatever the buyer decides. People often get confused and think that both ends have an option here. No, it's not possible for both ends to have an option. Now you say, well, why in the world would I give this clown the right to force me to do this stuff? And the answer is the option premium. We've already talked a little bit about it, but that's the amount that the buyer pays for the option. And so all those times that I was out there selling covered calls on Gene, I was receiving the option premium, and that was my, as long as I didn't get called out, that would be my profit. We'll talk about that here in a little bit. Questions? By the way, you can think of the premium on an option being like an insurance premium, right? You pay your insurance premium, and by the way, do you always exercise? No, in fact, you're kind of hoping you don't, right? You're hoping your car doesn't crash, or that you're not found to have lung cancer or something like that, that you're not going to have to use that insurance. And the option premium, sometimes it's the same way, especially if it's a put option. You're kind of hoping, I really don't want to use that, but it's good protection if I need to. When would be the other time that you would buy a put option? If you thought the company was going to take a royal dump, right? If you think everything's going to go to hell, then you would be smart to buy a put option. Have you guys heard of Muddy Waters? Muddy Waters is a group that they go around and they do investigations on companies, and they find companies that are basically cooking the books. And then what they do is they go out and they buy put options on that company, and then they release their research to the world. What should happen to the stock price if people believe their research? Yeah, it should plummet. And what's that going to do to the value of Muddy Waters options? Right? Does that make sense? And in the best case, that stock immediately goes to zero because that's the maximum payoff that they'll get. By the way, do you think Muddy Waters is usually right when they throw these reports out there? Oh yeah. Do you think there might be legal repercussions if they threw out false reports? Oh yeah. And so whenever they put a report out, I'm willing to take it to the bank. An example, there was a forestry company in China, and Muddy Waters figured out that they were reporting that they owned more acres of trees than existed in all of China. Is that possible? No. And so they knew right there that they were full of crap. And so they sold some they bought some put options, and then they released the report. So let's talk about the payoffs to call options. The payoffs, and this is the payoff to selling a call. This is the payoff to selling a call. And you can see that the payoff here is zero right up until we hit the exercise price. And at that point, you're going to lose $1 for every dollar that the call or that the stock goes up. This is the call option, right? And notice that that is exactly the mirror image of that. It's exactly the mirror image of that. Put option payoffs. If you sell a put, you're hoping that stock price stays above the strike price. But if it goes down to or below the strike price, then you lose $1 for every dollar that the shares drop in value. Now, I did not create the profit pictures for these, but it's easy enough to see that if you sold a $10 premium put option, your profit would be $10 right up until you hit 50. And then you're going to drop $1 of profit for every dollar the stock price falls. So when would you break even? Basically zero profit at 40, right? Because it's going to be the strike price minus the exercise, or the strike price minus the premium. And then from then on out, it's just pure loss. And if you want to see what a put option profit would look like, it's just the mirror image of that. So the profit from selling a put option is the mirror image to the profit from buying a put option. Once again, it's a zero-sum game. This is how options are quoted. We have over here the company ticker, IBM. And on the day that this snapshot was taken, IBM was trading at 138 and a quarter. That would be S sub T. Here S sub T is 138 and a quarter. The strike price, which is E, or exercise price, is given in the next column. And notice that we have more than one exercise price here. And this is typically the way it works. You're going to have a range of exercise prices of the potential prices that people think the stock might end up at before the expiry date. And by the way, the expiry, look at that. We've got different expiry dates. We've got different expiry dates. Now let's take a look at our call and put options. So if we've got let's look at the July one that's all red here. If we've got a July put option that's got a strike price of 135 and the stock price is currently 138 and a quarter, how much is the intrinsic value of the option per share? Yeah, it's $3.25 because it's 138 and a quarter minus 135. But if we look over here and see what that call traded at last, it's 4 3/4. 4 3/4. How much is the intrinsic value of that option?
1.5.
Yeah, it's 1.5. We just take 4 3/4 minus the intrinsic value of 3 1/4 gives us 1.5. So that's how we can dissolve this stock or this premium, the option premium, into its two pieces. All we have to do is figure out the intrinsic value and then subtract that out from the option price to give us the speculative value. Okay, let's take a look at an option that is out of the money. How about the July call option? The strike price is $140. The stock price is only $138.25. What's the intrinsic value of that option? You're tempted to say negative, but remember that the value of the call is either the maximum of the stock price minus the exercise price or 0. So what's the intrinsic value? 0. Now let's see if they're charging money for this thing. They are. They're charging $1.75 for that call option. How much of that is speculative value? All of it. The option premium for out-of-the-money options is entirely speculative value. The option premium for out-of-the-money options is entirely speculative value. I'm going to say it one more time. The option premium for out-of-the-money options is entirely speculative value because there is no intrinsic value. So we've kind of talked about calls. Let's talk about some puts here. So let's look back at that same 138 1/4 for July. This time we'll look at the put. What's the intrinsic value of that put option? By the way, if the call option's in the money, the put option must be out of the money. And so if it's out of the money, the intrinsic value is how much? Yeah, it's 0. And so every bit of that 13/16 must be speculative value. Now, where do we see intrinsic value on those puts? When the strike price is below 138 1/4. And so, actually, when the strike price is above 138 1/4. So when we get up to 140, we start to see some intrinsic value. What's the intrinsic value of the July 140 put option? Remember, for put options, we just swap that ST minus E. Now it's E minus ST. And so we've got this exercise price of 140 minus 138 1/4. Is that $1.75? And so that's our intrinsic value. But that thing is actually selling for $2.75. So how much is the intrinsic value on that? Sorry, how much is the speculative value? That's $1, right? Now take a look at the July and the August. The July and the August both have the same strike price and the same exercise price, but notice how much higher the prices are for the August versus the July. Why is that? Because there's still more time left for the share price to change, so those options have greater value. Now, let's talk about it's never optimal to exercise an option early. If I exercise these options, all I get is the intrinsic value. If I exercise the options, all I get is the intrinsic value. If I exercise the option, all I get is the intrinsic value. But if instead of exercising the option, what if I sell the option? then what do I also get? The speculative value. So that's why it's never optimal to exercise an option early. And there will be some smartass that talks about certain dividend payment patterns, blah, blah, blah. Okay, whatever. But typically what we're saying here is true. It's never optimal to exercise an option early because you're giving up that speculative value.
And that's for both call and put?
Yes, absolutely. So let's say that the share price was down and I was $25 in the money on my put option. I could exercise that and get $25 out of it, or I could sell it and get $25 plus the speculative value. Questions? Okay, now we're going to talk about something called put-call parity. And you should write this formula down on your note sheet. You should write this formula down on your note sheet. And I'm going to show you something else here. Here in this formula, I'm using E divided by 1 plus R to the T. And I want you to know that for purposes of a multiple choice exam like I'll be giving you, this is basically the same as E divided by E to the RT. The only difference here, this is continuous compounding. This is not. For the short periods of time that we're talking about, it's going to make a few cents worth of difference, and I will not make the choices so close that you'll have to worry about it. And so for my exam, perfectly fine. For my exam, for my homework, perfectly fine to use this. On the practice, if they tell you it's continuously compounded, you end up needing to use this. Okay, now it turns out there's a relationship between the price of the put, the value of a put option, the value of a call option, the stock price, the exercise price, the risk-free rate, which by the way, that R is the risk-free rate, and the amount of time that is left. And how can we demonstrate that? If we take a call option plus a bond that is got a face value of the exercise price and a date of maturity that's exactly the same as the expiry on our option, then we can show that if we add those two things together, their payoffs look like the red line. And that red line is equal to the payoff on an option, a call option, and the owning of the stock. And you can actually go through and show and prove that to be true. But that's why we can say this relationship. Now, why is this relationship important? Because it means that if I can give you the put value of the call value, I can ask you to calculate the stock price. Or if I give you the put value of the stock price, I can ask you to calculate the call option value. And so if you know all the things but one, you can calculate the other thing. That's the great thing about algebra. Now, some of you are not the best in the world with algebra. Am I speaking out of turn there? Some of you are not the best in the world at algebra. So what does that mean? It means that you should rearrange these things and have them all on your note sheet. So you should have this thing solved for P, you should have it solved for C, you should have it solved for S. Will I ever ask you to solve for exercise price? That sounds a little iffy. Probably not. Okay. Let's see what we can do with that.
The compounding equation you have up there, can you just clarify, is that E, a small e?
Yeah, that's the exponential.
Exponential.
Yeah, it's on your calculator. If you see, in fact, I'm going to borrow your calculator. Okay, thank you. If you look at the LN key, immediately above the LN key, it says e to the x. And the way you would get that would be by using the second, the yellow button. So here's what I'm going to do. Let's say it's 5% for 1 quarter. So I'm going to put in 0.05 times 0.25 is equal to 0.0125. And then I'm going to hit second L sub n, and that tells me that with compounding it is 1.2578452%. That's with continuous compounding. Now notice we're talking about tiny, tiny little differences here between 0.0125 and between 0.012, basically 6. And so that's why I'm telling you, for purposes of homework and exam, because they're multiple choice, that you could basically go either way with this.
So you can do it by hand that way, or you can just punch in and calculate it that way.
Yeah, you can use a calculator either way, right?
Yeah, that's quicker.
Depend, you know, for some people the E just blows their freaking mind. And so that's why I gave you this piece of information, right? For some people the exponential is like, whoa, how can that be? In fact, if you want to know what the actual value of E is, all you need to do is type in 1 second ln. And you'll see that it's 2.718281828, blah, blah, blah. I think it's kind of like pi, and then it goes on forever. Good question. Other questions? Okay, so we said up here that if we combine the payoff of this call and the bond, that it's going to look like that red line. But what if we buy the stock and a put option on that? Well, that stock is going to pay off 1 per 1. That's the green line. So as the stock price goes up, the value is going to raise $1. But what happens to the value of the put option? Well, that put option doesn't pay off anything until the stock price rises above 25, and then it starts to go up $1 for every dollar. And so if I've got that put option and the stock, then my payoff looks like this for that portfolio. And here's how we get to put call parity. If you look at those two red lines, they're exactly the same. They are exactly the same. And so we know, therefore, that the put plus the stock is going to have to be equal to the call plus that bond that has the face value of the expiration of the strike price and the same maturity as the expiration date of the option. Am I going to make you write any form? Am I going to make you prove that? No, absolutely not. Do you need to understand why that was happening? No. What you need to know is that this formula exists and you need to know how to use it. Okay, we've been talking about the value of the option and the formula. In fact, the formulas that we've talked about, the max stuff, that's all on the expiration date. But we said there's value over and above that. And that value, that difference, is going to be that speculative value. And we've already talked about that. But you can see that the market value of the option is always going to be greater than the intrinsic value as long as there is still time left to maturity. So we know that that call option, it's always going to fall on the bottom end between the max of the stock price minus the exercise price, or 0. And on the top end, the most it could ever be worth is the stock price. And so that red line represents the actual market value of the call. And then the green line represents the intrinsic value. Notice you can have positive market value even when this thing's out of the money, and that's entirely down to the speculative value. It turns out that back in 1973, by the way, options have been traded for a long time, but we did not know how to value them until 1973. Two guys, Myron let's see, Black-Scholes. Black-Scholes came up with this model, and they got it published. And it's really interesting because they were not actually the first people to figure this out. The first guy to figure this out was back in 1968. And instead of being a big old nerd and publishing it in an academic journal like Black-Scholes did, what that person did was founded their own hedge fund and made oodles and gobs buying underpriced options because they knew what the true value was, and they knew that in an efficient market that option value would eventually get back to its true efficient market value. And that guy made all sorts of money. I forget his name, but I saw him interviewed. He was like, oh hell yeah, 68 to 73, it was like a party. We were making money hand over fist. And he says, and then Black-Scholes had to go and ruin it by publishing their paper. Now, something else that happens in 1973 is when the Chicago Board of Options Exchange opens. So it's exactly the same time as we now know how to efficiently price these things. Now we've got this options exchange, and that's what opens up options to people like you and me, ordinary retail investors. And so Black-Scholes made it to where we could all know whether we were paying fairly for options, and bless them for it. Now let's take a look at the model. The call is equal to the strike price multiplied by a value returned from the normal distribution for a Z value of D1. Oh, what's D1? It's the natural log of the stock price over the exercise price plus the risk-free rate plus the variance of the stock returns, all that multiplied by T, divided by the standard deviation of returns multiplied by the square root of T. Holy crap, would you like to figure that out on an exam? No. And even if you did, then you would have to have a normal distribution to plug that number into, right? So I'd have to give you the tables. And that would still only give you that one term. What about the other term? Well, we've got the exercise price multiplied by our old friend E. And by the way, did you know that this is exactly the same as E times E to the negative RT? Because if you put a negative on an exponent, what does it do? It throws it down to the bottom, right? And so that's why this is exactly the same thing that we were talking about. Multiplied by a value from the normal distribution, and you can see what D2 is there. You have to have already figured out D1, and then you subtract the standard deviation times the square root of time. Oh my goodness. What happens if you screw up a calculation of D1? You've got no chance, right? Because it also screws up your calculation of D2. Now, I am not going to make you guys use this formula. But what can we draw from this formula? We can draw some understanding of what causes option values to go up and down. And we talk about calls and puts here. If the stock price goes up, then the value of a call goes up. That makes perfect sense, right? Because your intrinsic value of that option is going to go up. For a put, if the stock price goes up, the value of the put option goes down. And that makes perfect sense. There's no mystery there. And we can say the same thing about the exercise price. As the exercise price is higher on a call option, the value is less. As the exercise price on a put option is higher, the value is greater. Now, the interest rate. We notice that if interest rates go up, that's good for call option value, bad for put option value. Oh, and by the way, the Black-Scholes model that we just talked about here only gives you call. How are we going to get put? Because of put-call parity, right? If I can figure out the value of this call, then all I have to do is throw it into the equation to figure out what's the value of the put. Okay, Now, there are a couple of things that increase the value of both calls and puts. And the first one would be the volatility in the stock price. Remember, volatility is how much is jumping up and down, the variability as measured by the standard deviation of returns. That's what the sigma is that was in that last formula. The sigma is the standard deviation of returns. The greater that standard deviation of returns, the higher the option value is. And here's why. Which one? So my strike price on this call option is up here. My stock price is down here. Which stock has a greater probability of reaching this level? One that's doing this, or one that's doing this? Yeah, do you see that the more volatile one is more likely to be able to reach that strike price? And so that's why, and it's the same way on the put option. You've got your strike price down here, you've got your stock price up here. What's more likely? A stock like this or one like this getting down to that level? The more volatile stock is more likely to lead to an in-the-money situation for puts or strikes, or puts or calls. Now what about expiration dates? The further out in time, the greater the probability that the stock is going to be able to break through that strike price, either on the upside for calls or on the downsides for puts. So the more time that's left, the greater the value of the option. That's that speculative value. Now, what would I tell you you should do with this information? Put this chart on your cheat sheet. Put this chart on your cheat sheet. Shall I say that one more time? Put this chart on your cheat sheet. Because there's no way you're going to be writing down the Black-Scholes model and looking at it and figuring all that out during an exam. So better to just write this down, right? I talked earlier about a job offer being an option for the person that's being offered the job. And one of the things we used to do here was we gave people with a job offer with a really long due date. What do you think happened? People, by the way, finance professors know this, right? Finance professors know it's never optimal to exercise an option early. So what would they do? They would wait and they would keep interviewing at other schools, hoping to get a better offer. About 2/3 of them did. And so we lost a lot of our candidates. So what do you think the solution to that problem was? Yeah, we shortened it up, right? You don't want to make it like, you got to tell me now. But you could say, you've got 48 hours, or you've got a week. We were giving them like a month. And as a result, we lost a lot of good potential people because we were just giving them more time to get out there and look for other jobs. Questions? So let's talk about how options relate to corporate finance. It turns out we can treat levered equity as a call option. What do we mean by levered equity? What is leverage? It's the use of debt. So if you have a company that is 100% equity, we say that is unlevered equity. But if the firm uses any debt at all, then we say that equity is levered. And so if there's any presence of debt, we have this call option situation that shows up. So the underlying asset comprises the assets of the firm. So the underlying asset in the options we've been talking about so far have been shares of stock. And now we're talking about the underlying asset being the assets of the firm. And we can think of the strike price as being the payoff of the bond. So the face value of all those outstanding bonds. And we can think of the expiry of this option as the maturity date of the debt. The expiry is the maturity date of the debt. So let's think this through. If we get to the maturity date of the debt, and the debt is $1 billion. And at that point, the assets are only worth 600 million. What do? We let that call option expire unexercised, right? Because paying the strike price, the face value of those bonds, we would be buying the assets. But why would we buy those assets? Because after all, this option is out of the money. But what if instead you've got this $1 billion due at the end of, or at maturity? What if the assets of the firm were worth $1.2 billion? What would you do then? The assets of the firm are worth $1.2 billion, and you've got $1 billion in debt to pay off. What is $1.2 billion minus $1 billion? 200 million, right? 200 million. And so it's in the money. It's in the money, so we would exercise the option. We would pay the strike price of the $1 billion face value on the debt, and we would take control of the assets. However, if it's out of the money, we just walk away, right? And we let the people who sold us this call option, we let them keep the assets. Who sold us the call option? The people who loaned us the money. So that's a way to think of the levered equity as a call option. Okay. You can also think of levered equity as a put option because we are putting the assets to the debt holders. So you can think of it either as a call option or a put option. But here's what's interesting. Remember the things that change the value of an option. The volatility and the expiration date. Well, that expiration date is set by the maturity date, but the volatility can cause the value of a call or put, either one, to go up. So we're talking about the volatility of the underlying assets. So if I have a firm that has debt, then if I want to increase the value of the equity, which we can model as a put or a call, all I have to do is increase the volatility of the returns to the underlying asset. And so what can I do? I can go out and engage in a bunch of really risky projects. And that's going to raise the value of those call or put options. Now, if you were the person that was loaning the money to them, would that make you happy to know? No. In fact, if you look back at the savings and loan crisis in this country, we had savings and loans were in trouble because of the inverted yield curve, because they're having to pay more for deposits than they're making on the loans that they've made. They get to be in really bad shape. And so what do? They decide they're going to increase the value of the option on that equity by increasing the riskiness. So they go out and they make a bunch of really risky loans. What happens if the loans pay off?
They're good.
Yeah, they're good. And who gets the gain? The shareholders or the debt holders? Oh, come on. Who's a residual claimant?
Sure.
Yeah, the shareholders. So if those risky loans pay off, the shareholders win. If the risky loans don't pay off, by the way, the bank was, or the savings and loan was going under anyway. It was worth basically zero anyway. Who loses when the loans don't pay off?
Sure.
No, the debt holders, right? It's one of those heads I win, tails you lose, right? If I am a holder of the equity and I realize that the firm is in bad shape, what am I going to do? I'm going to go out there and do what's, so in football they would call it the Hail Mary pass. What's a Hail Mary pass? Mr. Nylon, you used to play football?
All the way down the field.
Yeah, it's like, what, 4th and 25 and you're on the wrong end of the field
Yeah.
and you're down by 5 points, what do? Hey, bud, go long. And you throw the football. By the way, this is all the football lingo that I know. That's it. If they catch the ball, you win the game. If they miss it, who cares? You were going to lose anyway, right? Does that make sense? And so that's what these risky projects or risky assets that these people invest in, that's what they're doing. And if they pay off, the shareholders win. If they don't pay off, the debt holders lose. Does that give you a different perspective now on the safety of debt versus equity? Yeah, a lot of people.
You're calling the savings and loans the debt holders?
So the savings and loans were owned by shareholders. The depositors were the debt holders. Now, here's where it really starts to stink. Was it really the depositors that were on the hook? Every account is insured by,
Yeah, but not the savings and loans.
back then, yes, it's true. Well, they had their own. They had their own federal insurance.
Okay.
I remember walking into a savings and loan in my hometown in the 1970s before all this crap hit the fan. And I look at the sign and I say to my dad, "Who's FDIC?" Because that's what the sign says, right? FDIC. And he explains it. And I'm like, oh. 5 years later, that very savings and loan, who's left holding the bag? The taxpayers. And so in this case, when those deals paid off, the shareholders win. When they didn't pay off, the taxpayers lost. And you may have heard this recently during the well, it's not recently anymore, the financial crisis. People were talking about capitalizing the gains and socializing the losses, right? If these companies win, it's the shareholders that get rewarded. If they lose, if there's some sort of guarantee, like too big to fail, then it's the taxpayers that take it on the nose. Does that make sense? Okay, we will start back here next time. If you enjoyed today's show, please be sure to like and subscribe.